What do I get the most sharp, terse letters coast to coast? That would be on the Fed and the job economy. Let's bring up a chart right now, which is extraordinary. I threw this out on Twitter last week, and I'm going to redux it here on a Monday, February morning. Claims as compared to employed. There's a nice normal trend here over 20, 25 years. We get an ugly, ugly financial crisis, and we get an improvement, which is out 1, 2, 3, three, four standard deviations maybe as well. Michelle Meyer, on the American labor economy, nobody buys the idea we're fully employed. Are we fully employed?
It's a tight labor market. You're saying it. I mean, Tom, that's a great chart. It just shows how low claims are relative to the amount of employment we have out there.
Right.
You can look at job openings rate. That's another good indication. We're running at high levels. The quit rate is very high. Clearly, just looking at the unemployment rate, we're below what most people consider full employment to be. So the labor market's tight. And I think the trend that we've seen the past 3 months,
right.
3-month moving average of 241,000 for
exactly.
jobs.
That's right where I
strong.
went. Exactly. And all moving average is really elegant. They're all sitting on each other. If the market's so good, you mentioned earlier that you just assume a Fed confronted with data will raise rates. What is the ramification to our viewers and our listeners if the Fed actually goes up another notch, another 2 notches?
Look, I think the Fed's going to be really careful in terms of how they do it. I don't think they're going to quickly change course and try to shock the markets again. I think it's going to be this gradual changing
based on evidence,
based off of evidence. And they have said data dependence. And if the data continue to show a strong economy, a tightening economy, one where eventually some pressures start to build up on the price front, I think it's justified for them to go, provided, of course, that risks mitigate and that financial conditions are accommodative.
Yeah, because, Michelle, I talked to some people who think the next move from the Fed could actually be a cut rather than a hike. So if you're looking at the hard data and you think the next move could be a hike and the conversation starts to pivot to that, what specifically would you and the Fed need to see in the hard data? Wage growth of 3.5%, something else?
No, I don't think so. It's not necessarily what you need to see. It's what you don't need to see in a sense. Right. So I think what the Fed is worried about right now is a slowdown. They're worried that the challenges abroad are going to feed into the U.S. economy via financial conditions, via confidence. So they want to make sure that that's not happening. And I think that they're worried enough about that it said, let's pause, let's wait, let's assess, let's see what's right, let's see how the U.S. economy could fare through these challenges. And I think if we get to the middle of the year and the economy is still progressing nicely and the recovery is ongoing and some of those risk factors wane, then I think it does set up for a rate hike. And at that point, I think the markets can take it okay because they also will have gotten past some of those risks. But what we're seeing now is that it's not the right time. It's not the right time to come out hawkish. It's the right time to be accommodative, to be supportive for the economy and to let the recovery continue.
Is the U.S. consumer strong enough to offset the risks from the rest of the world, Michelle?
So a lot rests on the shoulder of the U.S. consumer, but I do think that those shoulders are pretty broad and that we'll be able to see continued consumer spending, which will provide some hope for the broader economy. If you think about the backdrop for the consumer, it's favorable. Wages are rising, maybe not abruptly, but they are rising and they're more broad-based wage growth. The labor market is still strong in terms of the perception around the ability to continue to find a job. Wealth is still fine, even with the stock market correction
right.
In December, it's come back. So what's holding back the consumer? Confidence. We want to monitor that. That will be a factor. But I think the consumer is in a good place.
This is really important, folks. As Bank of America has a heritage of nailing the economic slowdown that we had over X number of years. Okay, so you've gone all optimistic. And what I would notice is real rates are a fiction compared to what's coming out of your mouth. I mean, what you are saying right now has nothing to do with the real rate structure. Where's the normal real rates?
Well, that is the interesting thing to characterize as optimistic. Maybe it's optimistic relative to what's priced into the rates market, but I wouldn't call it an overly bullish call on the economy. It's still a moderation. It's still growth returning to 2%, just above trend. But it's not a recession. And I think we're at a point in markets that as long as you're saying it's not a recession, it's not a contraction, that seems as to be positive. And that's the story that I think needs to start to change in markets. Right.